And let's examine the benefits and risk of investing in companies with regular stock buybacks. A company that announces buybacks regularly. What are the risk and reward of investing in those companies? Investing in companies that regularly buy back stocks can offer benefits, and also there are risks attached. So here is a brief overview of what we need to take into consideration. Let's talk about the benefits. Number one is a potential for stock price appreciation. There is that potential that the stock price will appreciate in future. So buybacks, as we all know, reduces the number of shares outstanding, which can lead to higher earning per shares and in turn increases stock prices. For the same level of profits, actually, the more the number of shares outstanding, the lower the earning per share, and the lower number of shares outstanding, the higher the earning per share. And so when the company buys back its stocks, it reduces the number of shares outstanding, and that would boost earning per share. And an increased earning per share will definitely have a positive impact in stock price. Number two is sign of financial health. Sign of financial health. Regular buybacks often indicates that the company has excess cash and believes its stock is undervalued, signaling confidence in future growth. If a company believes that its shares the shares are somewhat undervalued and there's availability of excess cash, the company could buy back shares. That signals that it has a sound financial health. Number three is tax efficiency. Tax efficiency is a very important benefit of stock buybacks. Buybacks are typically more tax efficient than dividends, as they allow shareholders to benefit from potential capital gains rather than income tax on dividends. And of course, when it comes to tax, dividend taxation, you discover that individuals are taxed at their income tax brackets, and such tax is not really applicable to capital gains that comes as a result of share buybacks. Number four is returns of capital. Return of capital. So investors may see buyback as a way the company returns capital to shareholders, especially if it has limited investment opportunities or doesn't need to reinvest all its profits. In the case where there are limited opportunities for a company to invest its excess cash or profits, the company may choose to return the capital back to shareholders, although with a kind of opportunity forgone, kind of. So number five is increased ownership. Increased ownership. Shareholders can benefit from an increased percentage of ownership in the company as buybacks reduces overall number of shares outstanding. Let's say you owned maybe 1% of the company as a retail investor, and there's a buyback. You may end up owning maybe 1.5 or 2% of the company, as the case may be. So generally speaking, there's always that increased ownership as a result of stock buybacks. Let's examine the risk. We've considered the benefit, the advantages. Let's look at the risk, the pitfalls, or the disadvantages of regular stock buybacks. Number one is short-term focus. Short-term focus. If buybacks are used primarily to inflate stock price or meet short-term performance target, example, boosting earning per shares, it can be a red flag for long-term wealth creation. You need to ask yourself, what is the purpose the company is buying back its shares? Is it to boost short-term earning per shares? If it's just for short-term purpose, then of course it will not go well with the company's long-term prospects or long-term value or wealth creation. Number two is debt financing. Debt financing. If a company takes on debt to fund buybacks, it could increase financial risk, especially if market conditions worsen or interest rate on the debts it incurred rises. So a company should buy back stocks when it has sufficient cash flow, not just going to borrow money to. Why do you need to borrow to buy back shares? I think it's not necessary, because it could saddle the company with additional debts, and by the time there's an increased interest rate on the debt, the company may experience financial difficulties. Number three is missed growth opportunities. That's opportunity cost. Because regular buybacks may mean the company is not reinvesting enough in growth initiatives such as research, such as developments, or expansion, potentially, limiting its future prospects. So as it's giving out this cash, there's an opportunity cost. The cash will have been invested somewhere to further boost the company's growth. Number four is a market overvaluation. Markets overvaluation. If the company buy back stocks when it's overvalued, it could be wasting capital that could have been better utilized elsewhere, leading to a decrease in long-term value. A company should not, under any circumstance, buy back its shares when the share price is considered overvalued. It needs to wait until when the shares are selling at below intrinsic value, when it's considered undervalued, before embarking on a buyback mission, or else it could be considered counterproductive for the long-term prospect of the company. Number five is dividend reduction. Dividend reduction. So if the company prioritizes buybacks over paying dividends, income-focused investors might miss out on regular returns. So while long-term investors may enjoy, but income-oriented or investors who are more keen on regular income through dividend may not really enjoy much. They may not really benefit much from this exercise. Investors like retirees may not get to enjoy. So in summary, investing in companies with regular buyback can be attractive for those seeking potential stock appreciation and tax efficiency. However, if it's important to watch for signs of short-term thinking, excessive debt, or missed growth opportunities. These are disadvantages you must take into consideration when it comes to companies that regularly buy back their stocks.